This is what happens if you trade a low-quality supply zone. And this is what happens if you trade a high-quality supply zone. But what exactly makes the difference? It's the time frame confluence that filters out bad zones from high-quality zones. And in this video, you will learn how to validate high-quality supply and demand levels. We start from a higher time frame, preferably the 4-hour or 1 hour. The market needs to have a clear and simple market structure to identify. As an example, right here on this market, after this wick has liquidated past lows, the market started an uptrend that's seen with multiple formations of higher highs with higher lows. After each higher high, the market breaks structure of the previous internal price action, entering into a new structure. But the most important factor you should know from the breaks of structure is that after it forms, the market will usually pull back against the movement that caused it. Which in this case, if the uptrend caused the break of structure, the reverse move will happen into a pullback. So that means that a downtrend forms, but inside the lower time frames, on the internal trend. That's important to know because this pullback is there to fill a demand, a support level, or an imbalance, just so the market can gather more buy orders at a lower price, eventually pushing higher and continuing the higher time frame trend, which obviously is bullish in this case. Now, a simple way to capitalize from a higher time frame demand is to zoom into a lower time frame once the market hits the demand. This is the same market, same price action, but just on a lower time frame, on the 30 minutes to be more exact. And here we have the 4-hour demand. And when you look at the price action the moment it fills that demand, you need to ask yourself why it bounced from this level. Why didn't it bounce from higher or from lower? Well, the answer to that is because this pullback filled another demand, but inside this time frame. And this theory can be applied once again if you zoom constantly, but most of the times, zooming just one time gives enough opportunities, so you don't have to lower down again, unless you want to scalp on the micro time frames, like the 1-minute chart, which can be done, but it's getting harder to properly identify higher quality setups. This is more than enough to give you a good setup. For example here, we clearly see that this buy position ended in a simple win, with the market breaking above the past external high, or swing high, that formed the break of structure that we've seen on the 4-hour chart. Now, let's come back into the 4-hour chart so we can continue the analysis so we can spot new setups. So as mentioned before, since we've had the break above the high, forming the new break of structure, after a break of structure, we expect a pullback, as mentioned before. Now here we see that it pulled back with this large bearish candle, leaving a wick then bouncing to the upside really quick, with the next candles closing bullish. And the same question needs to be asked, why did the market bounce exactly from there? And for that, you look at the bounce and closely take a look right on its left. And you'll see a demand level, and that's what made the price bounce to the upside on the recent price action. And to question why exactly from this level, to answer that, we need to zoom again into a lower time frame, this still on the 30 minutes chart, exactly like before, and by looking at the bounce, and more precise on its left, you will see how there is a demand level inside this lower time frame chart. And it's here exactly where the market filled and bounced to the upside. And similar as before, planning a buy-long position from the lower time frame demand, with the stop loss below the demand, or below the previous internal low, which in this case they have the same level. And the take profit, we need to look for logical exit targets, like a supply, a resistance, or an imbalance. In this case, we don't have a supply, since the market just went straight down lately. Not even a resistance, but we do have an imbalance, which is this entire level. Now, most of the old viewers of my channel know how to identify imbalances. They're basically found on a sequence of 3 or more candles, where we have the larger candle in the middle, and in the case of a bearish sequence, we take the lower wick of the candle previous to the large one, together with the upper wick of the candle next to the largest one. This entire level is called an imbalance. You might also have heard this as a fair value gap. They're the same thing under a different name. These imbalances act as resistance levels when resistances and supplies are not found. So we basically expect a rejection down from a bearish imbalance. Now this also coincides with the price being currently right on the imbalance. So logically, if we would place the take profit higher, we have a risk if this imbalance respects of getting stopped out. So it makes sense to get out of the position before that might happen. That translated into the chart is positioning the take profit as close as possible to the touch of the imbalance. But here, because this imbalance filled and had a small rejection to the downside, but currently the market's still pushing higher, we can place the take profit right above the past high. So now that you should understand the logic behind, we will look for a frontward test. So coming back into the 4-hour chart, what comes after is a break to the downside. So the uptrend looks to be ending. The way you notice that is when the past swing low breaks down into a swing lower low. You can see it here that we went from forming higher lows on the swing levels into forming a lower low. Now when this happens, we now have the market structure shift towards the bearish side. After a bearish shift, now we no longer expect higher highs, but you will see it many times how, at least in the short term, lower highs will be formed. So remember that after a break, there are high chances that we see a pullback, that based on the theory it should reject down from a supply, a resistance, or an imbalance. So we switched into a lower time frame to see the internal action of the pullback. This can increase our accuracy, and this time I'll try the 15 minutes one. It's chosen random, doesn't need to have an order or be a specific time frame because you will find similar opportunities on the 30 minutes and also on the 5 minutes as well. Now we see the market pulling back to the upside. Nothing unexpected or important so far. And this was the move that sellers wanted to see. Because if you closely analyze the structure of this pullback, you see that's formed with higher highs and higher lows. But then suddenly the market stops this formation and it breaks down below the past low, creating a lower low. Now this is exactly like the first minutes of the video. The break below the past low during an internal uptrend is a bearish trend shift. And this being on the lower time frame, so internally, this is an internal shift of the trend. And once again, after a major break, expect a pullback. And knowing that the pullback is there to fill a sell structure, we look for supply zones, resistances, or imbalances. And the first one is a supply right here. And you know the planning of the setup, but the take profit should have some logic, so let's look on the left of the chart for exit targets. A smart way of thinking is to exit on the previous swing lows, knowing this is a downtrend, and downtrends liquidate and break down past lows. This being the first important low, and there's another one. And the last one is the extreme, or swing low. Now if the market would break this swing low, this would be a continuation of the high time frame downtrend. It's basically forming the break of structure. Let's zoom out so you understand what I mean. On the high time frame, we had a higher high with a higher low, that later turned into a lower high, followed with a lower low, and so on. The probability of breaking the swing low is pretty high, because that's simply trading with the high time frame trend. As characterized with swing lower highs that reject back down from supply zones in order to continue the downtrend, into, of course, swing lower lows. So we put the theory into practice, but with a condition. That condition is to reverse risk and play it safer just in case the market doesn't respect the downtrend, because if we see a higher low with a higher high, then we lose this trade. This can be solved by targeting the upper levels. For example, this one, that just broke to the downside, then pulled back and filled the sell order. Since the first one is already used, we can go for the one from below. And pretty much right after filling the supply, the market continued far lower, even breaking below the extreme swing low. Now keep in mind, this should improve your trading, but there are more concepts and confluences to master. I have all of them on my trading materials where we turn profitable traders with a simple and straightforward system. It helped many traders, and it might help you as well. Take a look at the link below if you're interested, and have a great trading week.